On my last video of PayPal, I got a comment recently that said that I'm focusing way too much on the product side of PayPal and not enough on the actual stock to see if it's undervalued enough to be worth a buy. It kind of got to me for some reason, so I just wanted to obliterate that case. So, this is exactly what ended up happening. I ended up creating a spreadsheet that went across 25 of the largest retail companies, including PayPal and a lot of their competitors. So, you can see here like Global Payments, Fiserv, Adyen, Visa, MasterCard, a bunch of different payment companies. But then also, I wanted to add in a wide range of different styles of companies. We have healthcare, we have oil and energy, we have, Nvidia and Google and Tesla and all really high growth companies. But then on the other side, we also have like Altria and Philip Morris and a lot of the more value type plays or a whole range of different companies and everything in the middle. I then wanted to get the full earnings for these companies with three metrics that I thought could be as well compared as possible: revenue, net income, and free cash flow. Those I thought were pretty good. Then looking at the different growth rates of those companies through a historical 5 year revenue, historical 5 years of earnings per share, forward looking earnings per share, and then forward looking free cash flow as a percent basis, right? Then I wanted to go through and look at the valuations of all of these companies: price to sales, price to earnings growth or PEG ratio, and then price to free cash flow. Looking at every single one of those metrics, we can go through and select these companies and see which company has the lowest price to sales or which company has the lowest price to earnings value, which is a very important metric, right? So what we're going to notice already is that like companies like Altria, Johnson and Johnson, ExxonMobil, and PayPal, show up very low on or very high up on the low price to earnings ratios, where the very fast growing companies like the Eli Lilly's, the AMD's, the Nvidia's, Salesforce, they're going to rank really low because those are the very fast growing textile companies, right? So that is sort of across the board. Now, there's another metric that we need to look at whenever it comes to valuing these companies, and that's distributions, buybacks, dividends, and paying down debt. That is what can sort of adds into the shareholder yield, okay? Which we'll look at these distributions. So at the top, Altria, they're making cigarettes. There's not a whole lot of innovation going on. They have so much money to pour back into dividends. So they're going to be very high on this list, all the way down to, the very small companies on the other end. Let me sort by this. So Eli Lilly being at the very bottom, Global Payments, sort of these companies that might even be taking on a ton of debt rather than worrying about paying down debt or trying to do dividends or buybacks or something like this. So that's how you can get into the negatives if they're adding on debt. But most of these companies in the positives, and we can kind of rank them against each other. Now, instead of just going through and looking at all of these different metrics to see where PayPal ends up lying, right? I wanted to end up creating a ranking system so then we can value some parts of this company better than others. And so, what I ended up doing is creating a scoring list. We have a score list for all of the different metrics for here. Let me move my camera really quick. So, whenever comparing all of these different companies, if we want to look at, let's say, revenue, for example, then you can see that all the way 1 through 25 where each company lies. So at the bottom here for, revenue growth rates, we have Altria, Philip Morris, McDonald's, Walmart, Johnson and Johnson, PepsiCo, what we really think of often as value stocks. And on the other side, we have all the growth stocks, right? Adyen, Tesla, Fiserv, AMD, Nvidia, Global Payments, very common growth names. But how do we take a mixture of all of this? Because whenever you get growth, right, very like Adyen's ranking very high on growth, 1, 3, 8, 4. But then on the other side, on valuation, they're ranking extremely expensive: 24, 21, 14, 10. Right? So where can we find a company that sort of lands in the middle of all of these and kind of gets you a great amount of growth while not paying a high amount of value for that, right? Or on the multiple side, while potentially also adding on that heavy yield. So I created sort of a golf scoring, grabbing all of the metrics across every single different growth rate and putting them together to create a score that, if you rank the lowest, is actually the score that you want the most. I called it my golf score. Creative, right? I know. But if we sort this by lowest to highest, meaning the lowest from every single growth metric and every single valuation metric, what we end up seeing is that PayPal ends up being the lowest across every single metric. Now, this is because, the revenue is where they rank the lowest, but it's still a 10 out of 25. On their highest for PEG ratio, they are literally number one on the list. Now, this isn't seeming to be unpopular. Three of the companies in this golf scoring are also payment companies. Now, this does not mean that the companies that are scoring the lowest, Eli Lilly, Costco, Microsoft, that these are the worst companies to be buying, because that obviously is not true either. So, what I really want to preface this chart with is the fact that this does not talk about macro. This does not talk about the quality of the earnings, like whether, a company has brought on a ton of new money in one time event versus, reoccurring revenue that can be extremely consistent, like Costco, for example, right? So, there's a whole bunch of different factors that we have to weigh in that aren't necessarily being shown in this golf scoring. Probably the most prominent thing that we're not seeing here is that idea of competitive moats, right? Competitive moats, regulatory concerns, these sorts of things are not stuff that you're going to end up seeing on this list, because that's the reason why PayPal is getting such a discount right now, is because people think that they are losing that competitive edge versus companies that will be so sticky like MasterCard or Visa. Those companies are not losing their competitive edge. And so they continue to hold up very expensive valuations that are scoring them much lower on this, golf ranking. But in my opinion, while continuing to look at forward earnings per share, forward free cash flow, that PayPal, in my opinion, is currently worth the risk reward for my portfolio. Ladies and gentlemen, remember, this is just a company that I'm buying for me, but I wanted to share with you guys the way I'm looking at a company. So you don't have to do this for PayPal, but potentially consider doing this for other metrics that might work for your companies and compare them against other, of the competitors that they have, but also broader, wider ranges across different sectors. If they are metrics that you can, look at across different sectors. Obviously, we're not looking at banks or REITs or something like this that just couldn't be comparable in these metrics. Try to pick companies that are sector to sector comparable. Anyways, that's it. It's a shorter video. Hopefully you guys enjoyed. If you do, hit that subscribe button. That's all I ask of you. Until next time, guys. Bye for now.